Canadian Natural Resources just definitively beat consensus estimates for the second quarter of 2026.
Yeah, they really did. I mean, it wasn't even close.
Right, so earnings per share came in at $1.58, which easily cleared the street's estimate of $1.40 to $1.43.
And that top-line revenue hit $10.65 billion.
Which is huge.
Absolutely crushing expectations of $9.25 billion.
And management backed up those beats immediately, right?
Sure.
They raised their 2026 annual production guidance for the second time this year.
Yep, officially moving that target range to 1,637 to 1,682,000 barrels of oil equivalent per day.
And the market loved it. I mean, shares ticked up a modest 0.60% right after the print, but then they just surged 3.75% a few days later, significantly outperforming the broader market.
It's a massive response from investors.
So with those headline numbers on the table, here is the mission for this deep dive. We are unpacking a pretty massive stack of sources today.
We've got CNQ's official Q2 2026 earnings press release, their management's discussion and analysis.
Right, the MD&A plus equity research from Zacks, MarketBeat, and Public.com.
Lots of data to sift through.
Exactly. So we're going to analyze how CNQ actually achieved these record beats, break down their segment margins, and examine management's capital allocation strategy.
Which is getting pretty aggressive, by the way.
Very. And finally, we'll evaluate the regulatory risks that are currently putting a hard freeze on their future mega projects.
So looking at that $10.65 billion revenue beat, the foundational driver there is just sheer unadulterated volume.
It's pumping a ton of oil.
Exactly. Total corporate production hit a record 1,677,000 barrels of oil equivalent per day. That's an 18% year-over-year increase.
Wow, 18%.
Yeah, but that raw corporate number kind of masks the real story inside their portfolio. The undisputed crown jewel this quarter was the oil sands mining and upgrading segment.
Right. They hit their own record quarterly production there, didn't they?
They did. 624,754 barrels per day of synthetic crude oil, or SCO.
Okay, so hitting over 600,000 barrels a day of SCO, that requires your infrastructure to perform just flawlessly.
Flawlessly.
And the most striking data point to me in the operations report was the upgrader utilization rate. It ran at a massive 106% for the quarter.
Which is just incredible physical engineering.
Right. I mean, for those following the oil sands, an upgrader is basically this massive, highly complex chemical plant.
Right, because the raw bitumen they mine is super thick. It's like cold molasses mixed with heavy sand.
Yeah, you can't just put that in pipeline. The upgrader uses intense heat and pressure to crack those heavy molecules and make it a lighter synthetic crude.
Which refineries desperately want. But operating a facility of that immense scale at 106% utilization is wild.
It's like running a high-performance engine in the red zone, right? Or, operating a factory way past its nameplate capacity.
Yeah, it's like buying a commercial oven rated to bake exactly 100 loaves of bread an hour, but your engineers have optimized everything so perfectly that you're pulling out 106 loaves every hour.
Without burning any.
Exactly. And without breaking the oven. They ironed out the bottlenecks so well that they exceeded original design specs, all while dealing with some terrible weather up in the oil sands this quarter.
But wait, how sustainable is that pace? Running an industrial pressure cooker at 106% means you're wearing down the physical components, the pipes, the valves, at an accelerated rate.
Well, that's the catch.
Because management noted in the MD&A that there's a planned 35-day turnaround scheduled for the Horizon facility in September.
Right.
And that's going to impact production by about 29,000 barrels a day.
Yeah, turnarounds are just a standard, unavoidable reality in heavy industry. You have to take the plant offline, bleed the pressure, inspect everything.
Right, replace the spent catalysts and all that.
Exactly.
Yeah.
So while production dips in Q3 due to that downtime, that 106% figure proves that when they turn it back on, their baseline efficiency has just fundamentally leveled up.
Makes sense. And they had similar operational excellence outside of the mining segment too, right?
Oh, yeah. Their North American conventional E&P liquids hit a record 338,000 barrels per day.
Which is a 25% increase year over year. That's huge. But I want to talk about the thermal in situ assets for a second because the physics of how they extract this oil is fascinating.
The SAGD pads.
Yes, steam-assisted gravity drainage.
Yeah.
The report highlighted 2 new SAGD pads at their Pike 1 asset. They're exceeding expectations with a steam-to-oil ratio, or SOR, of 1.x.
That 1.8x is a phenomenal number.
Right, and just to quickly break down CIGD for you, instead of mining the surface, they drilled two parallel horizontal wells deep underground. One is about 5 meters directly above the other.
Right.
They pump high-pressure steam into the top well, which acts like a double boiler melting chocolate. It heats up the bitumen until gravity pulls it down into the bottom well where it's pumped up.
And that steam-to-oil ratio is basically the ultimate scorecard for how well that thermodynamic process is working.
How much steam you need per barrel of oil.
Exactly. An SOR of 1.8x is absolutely top tier globally. Generating steam takes massive boiler plants, millions of gallons of water, and burns enormous amounts of natural gas.
So a lower ratio means less water, less gas, fewer emissions.
And drastically slashing the capital required to produce those barrels.
Okay, but pumping 1.67 million barrels a day is great, but volume is only half the battle. If it costs a fortune to run these upgraders, the volume doesn't actually translate into profit.
Right, margins matter.
So how much of this record volume is actually flowing through to the bottom line?
Well, this is where that 1.8x SOR and the 106% upgrader utilization really pay off. In the oil sands segment, their operating costs dropped 16% year over year.
Wow. Down to what?
An industry-leading 22 Canadian dollars and 19 cents per barrel,
Oh, man.
which is just US $16.03 a barrel.
Operating heavy machinery, giant haul trucks, and chemical upgraders for a total cost of $16 a barrel is just remarkable cost discipline.
It really is. And when you combine that rock-bottom operating cost with current macro pricing, it's just a cash printing machine.
Right.
CNQ reported the highest per barrel netback in company history this quarter, 78 Canadian dollars per barrel.
$78. That is pure margin sitting in the bank after every operating expense and government royalty is paid.
Exactly.
And a big chunk of that netback is tied to what analysts are calling the SKO premium. In Q2, their synthetic crude captured a massive premium to the WTI benchmark, averaging an extra US $8.37 per barrel.
Refineries love SKO because it's essentially a light, sweet crude. Since it's already upgraded, it's cheaper to refine into gas and diesel.
Right, and the sources point to macro tailwinds driving this Middle East supply disruptions and a very tight global refined product market.
The world was starved for high-quality crude, and CNQ had 624,000 barrels a day of exactly what they needed.
Wait, hold on, though. An $8 premium sounds fantastic on an earnings call, but isn't that just a lucky break from global conflicts?
That's a fair question.
I mean, geopolitics are volatile. If the Middle East stabilizes tomorrow or supply chains clear up, won't that massive margin just vanish overnight?
That is exactly what institutional investors are asking. The premium is absolutely going to fluctuate. In fact, management admitted that the 2026 strip pricing implies an SKO premium closer to US $3.80 per barrel.
Okay, so nowhere near the $8 from Q2.
Right, but a compressing premium doesn't break their business model. They don't control geopolitics, but they completely control that $16 operating cost.
Ah, I see.
Their internal break-even is so low that even if the premium drops to zero, they still print billions in free cash flow. The $8 premium just gravy. The efficiency is the actual meal.
That makes a lot of sense. And they're also finding margin in places the market completely ignores. Sifting through the MD&A, I found this fascinating secondary revenue stream.
The sulfur.
Yes. CNQ produces 30% of Canada's entire sulfur supply, which is actually 2% of the global supply.
Which is wild for an oil company.
Right. It's just a natural byproduct of upgrading bitumen, but it's critical for global agriculture and fertilizer. So because sulfur prices were strong, they generated 270 million Canadian dollars in net revenue just from sulfur sales in Q2.
Monetizing waste to the tune of $250 million every 3 months.
It's the ultimate expression of maximizing a resource base. Record volumes, $16 operating costs, structural premiums, and 9-figure revenues from byproducts.
And all that generated an immense 6.9 billion Canadian dollars in adjusted funds flow for the quarter.
Right. So with $6.9 billion washing over the balance sheet in a single quarter, the immediate question is, where is management putting this war chest?
Returning it to shareholders mainly. Total returns in Q2 hit 4.9 billion Canadian.
Wow.
Yeah. Breaking it down, 2.4 billion went to direct returns. So that's 1.3 billion in dividends and 1.1 billion in buybacks.
Nice.
And the remaining 1.6 billion was deployed to aggressively reduce net debt.
But they also deployed capital for inorganic growth, right? They closed a $761 million strategic acquisition in the Peace River area.
Yeah, these tuck-in acquisitions are super strategic. They
Yeah.
buy adjacent acreage where they already have infrastructure, so they don't need to build new pipelines to bring the oil online.
And what's crazy is that even after dropping $750 million on this, their operating capex guidance for the year is totally unchanged at about $6.0 billion.
Absorbing a massive asset purchase without blowing out baseline spending targets is a huge signal of capital discipline.
Definitely. But the real focal point for the analysts right now seems to be the magic number. Management set their next net debt target at 13 billion Canadian dollars, which they expect to hit by early 2027.
Right, and that 13 billion figure represents a leverage ratio where the balance sheet is functionally bulletproof.
Regardless of commodity cycle.
Exactly. Right now, they return 75% of free cash flow to shareholders and use the rest to pay down debt. But once they hit 13 billion, the policy shifts to returning 100% of free cash flow to shareholders via buybacks.
Going from 75 to 100% is going to unleash a massive wave of capital into the market. And this is on top of a dividend policy that's already incredibly strong.
Oh, fiercely protected.
Right. This year marks their 26th consecutive year of dividend increases, currently sitting at an annualized $2.50 per share.
Which in the energy sector is almost unheard of.
It's like an unstoppable freight train. I mean, they raised it through the 2008 financial crisis. They raised it during the 2014 OPEC price war.
They even raised it during the 2020 pandemic when oil briefly went negative.
Exactly. It's the ultimate stress test of that $16 cost structure we just talked about.
The dividend history proves the business model works. But that impending shift to 100% free cash flow returns introduces an interesting dynamic for the stock today.
Right, which raises a critical question for anyone watching this price action.
Hmm.
Given the rapid deleveraging and that 3.75% stock surge we saw, is the market already front-running the 2027 policy?
Markets are always forward-looking.
Exactly. If institutions see that 13 billion target approaching, they might be aggressively buying today to get ahead of that massive wave of buybacks.
The market almost always rewards clear line of sight. When the math on debt reduction is this transparent, valuation multiples usually adjust long before the target is actually crossed.
So if a company is operating at 106% utilization, pulling oil for $16, printing free cash flow, and smoothly integrating acquisitions, the logical next step would be to greenlight massive new domestic growth projects, right?
You'd think they'd be building the next generation of mega mines.
Right, but they aren't. Let's look at the regulatory risks that have put a total freeze on CNQ's future expansion.
This is the critical pivot in their story right now. CNQ has officially put all of its medium and long-term domestic mega projects on indefinite hold.
And we aren't talking about small upgrades here. These are massive multi-billion-dollar sidelined assets. They paused Jackfish, which is 30,000 barrels a day. They halted Pike 2, scoped at 70,000 barrels a day. They froze the Jackpine mine at Albion, which is a staggering 150,000 barrels a day.
Huge capacity.
And they shelved the Horizon in-pit extraction plant at 90,000 barrels a day. That is nearly 350,000 barrels of daily capacity. Larger than the output of some sovereign nations just sitting on the shelf. Why are they leaving that much oil in the ground?
Because deploying capital at that scale requires regulatory certainty, and right now the Canadian energy sector just doesn't have it.
Right.
The company stated they are waiting on definitive agreements from the Trilateral Memorandum of Understanding, or MOU, between the Oil Sands Alliance, the Government of Alberta, and the federal government.
Okay, let's look objectively at what this trilateral MOU actually is. The federal government has established national targets for reducing greenhouse gases. The Alberta government owns the natural resources and manages the provincial economy.
And the Oil Sands Alliance represents the energy producers.
Right. So the MOU is a formal attempt to bring all three to the table to establish a comprehensive regulatory framework. The mandate is to mandate GHG emission reductions while ensuring Canada's energy industry remains globally competitive. And they've set a deadline to reach definitive agreements by November 2026.
And this matters because an oil sands mine is a multi-decade asset. It takes billions in upfront capital before one drop of oil is produced and decades of operation to get a return.
You can't model that if you don't know the rules.
Exactly. You can't build a financial model for a 30-year asset if you don't know what emissions caps, carbon taxes, or government incentives will look like 10 years from now. The capital risk is simply too high.
Now, management called the MOU a positive first step in their press release.
Right.
But looking at 350,000 barrels of phrasing capacity, that phrasing sounds like a very polite PR way of saying we are stuck in regulatory limbo.
Yep. pretty much.
I mean, a first step means there's no actual roadmap yet. No
Okay.
board is going to authorize a $10 billion jackpine mine expansion if the fundamental economics of the 2030s are unknowable.
The freezing definitely reflects the tension there. I mean, the fact that industry and government are negotiating is objectively better than total gridlock.
Sure.
But until the ink is completely dry on those definitive agreements and the fiscal rules are locked in stone, that expansion capital is staying in the bank.
So what are the actual consequences for CNQ's capital allocation if November 2026 arrives and they fail to produce a workable agreement?
Well, if that deadline passes without clarity, the domestic capital bottleneck stays firmly closed.
Right.
CNQ will just keep operating its existing assets flawlessly. They'll keep generating massive cash, hit their $13 billion debt target, and probably accelerate that 100% free cash flow return to shareholders.
But long term?
Long term, the implication is a structural challenge with reserve replacement. If you aren't building new mines, your production growth curve eventually flattens out and declines as assets deplete into the late 2030s.
Which brings all the threads of this analysis together. We're looking at a company that has totally mastered the physical engineering of its current assets. They push upgraders past nameplate capacity, drive costs down to $16 a barrel, and effortlessly pay down debt.
They are a highly optimized machine running flawlessly on the current tracks.
But the tracks ahead are currently under construction by a committee of regulators, and nobody has agreed on the final blueprints.
The execution is flawless, but the long-term trajectory depends entirely on regulatory clarity that they just don't have today.
So here's a final provocative thought for you to ponder long after this deep dive ends. If those definitive agreements fail to materialize by 2026, forcing highly efficient operators like CNQ to sit on billions in cash indefinitely, what exactly do these companies become?
Right.
Do they just accept their fate as low-growth, cash-dispensing machines strictly for dividend and buyback investors? Or, armed with an impenetrable balance sheet, will they be forced to look entirely outside of Canada for major M&A opportunities just to secure long-term growth?
It is the defining dilemma of the industry right now. World-class operational execution running headfirst into regulatory ambiguity.
We will see how the negotiations play out as we approach that November deadline. Thanks for joining us as we unpack the numbers. Make sure you hit follow on the show so you don't miss our daily deep dives into the earnings reports that move the markets. We will see you next time.